Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to the latest episode of InvesTips from the CIO's desk. In the last episode we talked about equity mutual funds. Now today I want to focus on the natural counterbalance to equities in a portfolio, bonds, and in particular bond or debt mutual funds. We all know that equities have outperformed bonds over long periods of time. However, this strong performance comes at the cost of much greater volatility. Therefore, while the theoretical optimal allocation to equities might be 100%, at least for those with a long enough time horizon, most investors want to diversify their portfolios in order to smoothen the ride, even if it comes at the expense of reduced returns. Of course, one diversification is to put money on fixed deposit. However, this is generally suboptimal, as not only is the interest rate lower than on bonds, but it also does not rise in value when equities decline, which certain areas of the bond market can do. Therefore, for most investors, a significant allocation to debt instruments or bonds makes sense. Similar to equities, there are a wide range of debt funds to choose from. But simplistically, there are three key dimensions to consider when choosing which areas of the bond market are most suitable for you. First, the average maturity profile of the fund. Second, the credit quality of the bonds held in the fund. And third, the geographic diversification of bonds in the portfolio. So let's explore each in turn. In terms of maturity profile, you can invest in funds which focus on short-dated debt, such as treasury bills issued by a government or commercial paper issued by companies. Given the short-dated nature of the underlying debt, these may be best suited for parking your emergency cash, as it should be easy to exit the fund at any given time without the risk of material capital losses. At the opposite end of the spectrum, you have long duration or maturity profile funds, which invest in bonds that have a very long maturity profile, up to 20 to 30 years, and in some cases, even 100 years. These will generally offer a higher level of income or yield. However, the value of the investment is much more sensitive to the level of interest rates. Now, it's important to understand that this can be both a positive and a negative. On a standalone basis, of course, it means the investment in bonds with a long maturity profile is more volatile. However, if you have significant investments in the stock market, then this volatility can actually be beneficial. Equities often fall sharply when concerns about economic growth increase, and this usually results in interest rates falling, boosting bond prices, especially those bonds with longer maturities. This can therefore help to smoothen the performance of your overall portfolio once you take into account equities are falling but your bonds are rising in value. The second dimension is credit quality. Now, there are investment grade bonds and high yield bonds. Now, investment grade bonds are of a higher credit quality, which means the probability of the borrower defaulting is lower. Now, high yield or sub-investment grade or junk bonds have a much higher risk of defaulting. This is important because if the issuer defaults, they stop making interest payments and the investor risks losing the vast majority, and possibly all, of the investment made in that bond. As always, there's a trade-off. Lower quality bonds offer higher interest payments to the investor, but they also offer lower diversification benefits, as equities and high yield bonds are both likely to suffer in a recessionary environment. Of course, mutual funds in themselves help to mitigate credit risks, at least to some degree. If you own one bond and the issuer defaults, then you have all your eggs in one basket and you could lose all of your investment. However, if you invest in a bond mutual fund, then you will likely have exposure to over 100 borrowers. Of course, if the economy weakens dramatically, then all companies are likely to be hit to some degree, but not all of them will default. This diversification reduces the size of potential losses. The final lens is the geographical distribution of the bond issuers in the portfolio. Some markets are lower risk and have a much deeper and diversified bond market, such as the US. However, some markets, especially in the emerging markets, are much riskier and concentrated in certain sectors, either directly or indirectly. If the fund invests in bonds issued in different currencies, then this needs to be factored in as well. Of course, the above is a simplified overview of debt mutual funds. In some markets, there are also bonds that protect against inflation, and some funds will invest in debt that is backed by collateral in order to reduce the credit risk to some degree. So after all this, how do you pick a debt fund that is suitable for you? Well, the first and most important step is to identify what your investment goal is and then choose from the range of debt mutual funds accordingly. If it is your emergency money to protect against sudden job loss or large expense, then a fund holding short maturity and high quality debt makes the most sense. If you're trying to generate income, then a blend of investment grade and high yield funds might make sense. And if the focus is diversifying away from significant equity market exposure, then investment grade and medium to long dated bond funds probably is best for you. Of course, we often have more than one objective, and this is why a blended asset allocation approach likely is important for most investors. But as always with investing, the starting point is you. Thanks so much for joining us today. I hope you now have a better understanding of how bond mutual funds can help build the foundation of a diversified portfolio, as well as the things to consider when looking at funds in isolation. Next time out, we'll discuss mutual funds which offer exposure to both bonds and equities, rather than just a single asset class. I look forward to catching up with you then. In the meantime, please take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.